Good afternoon. I'd like to call to order the House Finance Ways and Means Appropriations Subcommittee. The members of this committee have been in finance hearings thanks to Chair Lady Hazelwood all day, so they're tearing. So because we're not going to transact any business, we're going to suspend with calling the roll. So Mr. Jaragano and his staff can go ahead with their presentation, and then they can catch up online or in person as soon as they walk through the door. So we are going to suspend with calling the roll, and without objection, we're going to go into session or out of session to hear from revenue. Today's topic, the members have gotten some information regarding F&E tax to their emails prior to today. That information was to better help the members understand the F&E tax, its impact on the state's budget, and how if we were to make modifications to the F&E tax in the future, what it would look like in spite of what we've done in the past. The members will also have on their email was some information or notification that after Mr. Jaragano's testimony today and questions, that we would also hear from Commissioner Branscombe regarding the mega site progress. Because of some discussions with the speaker and the inability of some members outside of general services to attend, the speaker has requested that we have a separate date only for the mega site so that we can discuss TDOT's the impact on TDOT revenue. I'm sorry, not revenue. TDOT environment conservation, economic and community development, and the mega site authority themselves. So you guys can stay tuned. You're going to have a briefer discussion today than you expected. So with that being said, Mr. Jaragano, if you would please, for the record, introduce yourself and who's with you today, and you may begin.
Thank you very much, Mr. Chairman and members of the committee. Really appreciate the invitation to be here with you today to talk about franchise and excise tax. Here at the table with me is Jeff Biarkey. He's our Director of Research, sort of help me answer questions as they arise. We have some other colleagues from the department here with us in the audience as well. Mr. Chairman, these first two slides are going to look familiar because I included them in the sales tax presentation, but I think they're relevant here as well for some of the similar reasons. I won't spend a lot of time on them because we've talked about them before, but I just wanted to reiterate in connection with franchise and excise tax that it is our second largest tax in terms of the revenues collected by the Department of Revenue to fund the budget. And F&E comes in at about 19%, second only to sales and use tax. And as I mentioned before, when talking about sales tax, those two combined represent 80% of what we collect and really about 90% of what funds general government operations. This is just a snapshot. I shared this last time as well. In FY21, corporate franchise and excise tax collections were about $3.5 billion. So I think more to the point, what is F&E tax and how does it work? In short, starting with who pays franchise and excise tax, it's imposed upon entities that essentially offer limited liability protection to their owners. Of course, as with any major law, there are nuances and exceptions, but generally, if you were one of those types of entities, primarily corporations, limited liability companies, and limited partnerships, then you're going to be subject to franchise and excise tax. Obviously, that it then excludes general partnerships, sole proprietorships, et cetera, are not part of this tax. Franchise and excise tax are actually two separate taxes, but they are administered together. You file on one return. The same, for the most part, the same entities are subject to both taxes, and they're essentially administered and reported together as F&E tax. F&E tax collections, what do they fund? They generally almost exclusively go to the general fund. As opposed, we talked quite a bit in the sales tax about different allocations, but with F&E, the actual use of the tax is much more straightforward. It's a general fund tax. The only real exception is something generally known as the bank excise tax. There is a portion of the excise tax collected from banks, investment companies, and cemetery companies that is allocated to the city or county where those businesses are located. As far as the rates and how the tax is calculated, the franchise tax is 1/4% on the greater of the company's net worth or its real intangible property located in the state. So there are two different bases. You calculate both, and it's whichever is greater creates the tax base, and then the rate is essentially 25 cents per $100 in value. Excise tax is 6.5% of Tennessee taxable income. And there's a lot that goes into that. For the excise tax in particular, we start with federal taxable income. So when you go to fill out your Tennessee excise tax return, which is in essence it's a corporate income tax, just like the federal corporate income tax. When you go to fill out your Tennessee excise tax return, you don't start from square one. You've already computed federal taxable income so that you can file your federal corporate tax return with the IRS. And that's really the starting point for your Tennessee excise tax return. So you take your federal taxable income, you bring that down. That's basically line one of your Tennessee return. And then there are various Tennessee specific adjustments that are made to that taxable income to arrive at your Tennessee taxable income. And then the rate applied to that is 6.5%. Another important part of excise tax is apportionment, however. And this would be a factor in a return filed by a company doing business in more than one state, doing business in Tennessee and elsewhere, that's filing returns in more than one state. There has to be a methodology for how much of their total income is attributed to their Tennessee activities and is subject to our tax versus their activities and the taxes imposed by other states. And so that's what's generally referred to as apportionment. And that applies both to your net income and your net worth for franchise tax purposes. So, and that can be almost as important as the rate. I mean, there is a lot that goes into how a state addresses apportionment, what its apportionment formula is, how its apportionment formula works. And there's been discussion about that over the last few years. There have been some changes, as you'll recall. The subject of having a single sales factor is something that that you've likely heard discussed, and that's really about apportionment. And the traditional apportionment formula is based on three factors: property, payroll, and sales in the state. And those factors can be weighted differently. For example, in Tennessee, we generally have a three-factor formula, but sales are weighted more heavily than property and payroll. And then for manufacturers, and this was the big change in the Improve Act, for manufacturers, we went to an elective single sales factor, which means in computing their taxable income, apportioned to Tennessee versus other places, if they do business in multiple states, they don't look at property and payroll at all. They're only looking at sales, and that can be advantageous to those businesses. So we could talk for the whole, we could have a whole session on apportionment. I don't mean to go down a rabbit hole, but I just want to stress sort of the importance of how you determine what is taxable is very important in conjunction with looking at the rate. They're both very important to determining the actual liability of a given company. Lastly, there are various credits. You're familiar with job tax credits and industrial machinery credits and others, and also net operating losses that can reduce the liability on a return and can, in many cases, be carried forward to future years. Real quickly, usually folks are interested in a comparison of rates. This is a map from the Tax Foundation of the various corporate income tax rates. So what would be our Tennessee excise tax? We have, as I mentioned, 6.5% rate. That is sort of middle of the road nationally. It is in the top tier as far as the Southeast region. But again, uh, the apportionment formula is also an important factor in final liability. And we're also competing, in essence, with states that have income taxes, and we don't. So they're getting a large percentage of their total mix of revenue from individual income tax, which we do not have. So that has to be taken into account as well. Additional considerations when you're really sort of studying and really trying to understand F&E and the revenue picture and how it affects the budget. One important factor that I think is important to keep in mind is that really uh, a large percent of the revenue from F&E tax comes from a very small percentage of the taxpayers. So 40%, give or take, looking at tax year 19, 40% of the revenue came from just 18 hundredths of the taxpayer, 0.18% of the taxpayers. 74% of the revenue came from fewer than 2% of the total taxpayers. And in contrast, if you look at the sort of the bottom 85% of taxpayers account for only 4.5% of the tax. So it applies to a large number of taxpayers, but the big money is really at the top. So what that means is um, those taxpayers are very key to collections. If there are changes among a relatively small number of large taxpayers, that can really be seen pretty quickly in collections figures. It also means changes that we might make are going to impact those a relatively small number of taxpayers um, to the largest extent. Whatever those changes may be, the impact is going to be concentrated just like the collections are concentrated. Another issue is with timing. Um, F&E payments are made via quarterly estimated payments for most taxpayers. So during their tax year. So we're right now in beginning tax year 22. If you're a calendar year taxpayer, calendar year taxpayers will make estimated payments throughout this year. But then they won't file their return until sometime next year, as much as 11 months after the end of their year. So if you think about the first estimated payment, again, for taking a typical calendar year taxpayer, if you think about the first estimated payment being made in April, and then that company doesn't file its return until not this November, but next November, that's a total of 19 months over which their sort of that one tax year plays out. And it actually crosses over 3 state fiscal years or 3 budget years from the time they make their first estimated payment until they file their final return and true it all up. Can be as much as 19 months, and it can cross as much as 3 state fiscal years or 3 budget years. So it really plays out over time. And I think both of those factors, as well as others, sort of lend themselves to sort of the volatility that we talk about a lot. And I know we talk about that a lot in general, but most of that, or uh, the biggest part of that, the biggest factor, single factor, is franchise and excise tax. And this slide we call it the volatility chart. We've been looking at this and using this for a while. There's a lot on this chart, but in essence, what you're seeing there is the relative volatility of franchise tax, sales tax versus the economy as a whole. If you look at those two lines at the bottom, the dashes, those represent GDP and also the consumer price index. So proxies for the economy as a whole, and you see that they are quite low in terms of volatility and really flat. The blue line just above that would be sales tax, the solid, I think that's blue or green. The solid line above the dashes is sales tax for comparison. But if you look at the red line at top, that's F&E. So that's showing the volatility over a 10-year look-back period, the average volatility in franchise and excise tax, the amount by which it changes from year to year. And I think what's really telling about this slide is, one, that it's the highest in volatility compared to our other taxes and compared to the economy as a whole. But even more than that, the fact that it's increasing in volatility as you see it going up as it moves from left to right, particularly from around 2007. That curve has really gotten steeper. So it's the most volatile, and over the last 10 to 14 years, it's become more increasingly volatile, just in terms of the percent change from year to year. And so finally, Mr. Chairman, this is a bar graph that sort of illustrates that. Going back to 2008, there's 14 years on this graph. And you can really see it's hard to find 2 years that look the same. I think if you look at FY10 and 11, they're pretty close to the same, but otherwise, it's pretty different every year. And you see 4 years, which showed significant growth, but you also see 4 years that were negative growth. Now, as you pointed out, we were speaking earlier, one of those years was a rate cut. The FY18 year was affected by a rate cut, but the other years were not. And you can just see some really big growth years and some really big negative growth years. And you almost start to see you're not going to go too many years before you see a significant change. So, Mr. Chairman, those are sort of my prepared remarks. We would be happy to try to answer any questions you may have.
Thank you, Commissioner, for coming. If you could back that up one slide, I just thought I would ask a question based upon this slide in particularly, but I can't see when it translates from you to the dashboard. The third red dip there is, I think, the most memorable period of service that I've had in the legislature. I think this was the year that F&E taxes were undercollected, or the expectations when they were under of what they would be fell short. I guess the question, one of the questions, and I've got several, so I apologize. Was that because the estimates we were overestimating because we're realizing those, or did the actual collections themselves fall because of the single factor variant? Because I'm trying to figure out how we go from 1 year having something that's extremely volatile to 3 years later cutting taxes by $700 million.
Yeah, I mean, I would say, first of all, the two dips at the beginning, 8 and 9, obviously was the result of a recession.
Mm-hmm.
14 was really out of the blue from our perspective, and I don't think it was estimated differently. I think it was a typical estimate for that year.
Mm-hmm.
It was completely unexpected, and really a lot of it was unexplained. There were some factors that were identified and discussed at the time, with some changes in the way some businesses within a particular industry were moved around, and that sort of goes to my other point about a few businesses can really impact collections if they change what they're doing, or if their profits, unexpectedly fall off, or that sort of thing. So there were some factors, but that were identifiable, but it certainly didn't explain the entire picture, or why it dropped by 8.4% that year. And, in terms of how we got to being able to cut taxes, obviously we saw a couple of good years out of the next three. I think it's just somewhat cyclical. We all know there is a business cycle. The F&E tax is subject to business decisions, as well as the national economy. Again, another picture is, sometimes folks rightly think about how Tennessee is doing, but a lot of the money comes from big national companies,
Mm-hmm.
and it's their overall profit, and it depends on how companies are doing nationally, that drives it as much as it is how companies specifically in Tennessee are doing. I don't know, Jeff, that was before your time. I don't know if you have anything you would add to that. Okay.
Just another follow-up. One of the comments that we hear from industry is that, our F&E tax rate is so high. It's one of the top 5 of the highest ones in the United States. I'm not sure when you take into consideration all taxation as it relates to that is the case, but with the F&E tax, what would you say to those businesses who are looking to Tennessee that they look at that rate as a reason why they should come here, and if we were going to, well, let me let you answer that question first.
Yeah, a few things. One, I'll just put the map up while we're here. I think we compare favorably to a lot of other places in the country with our rate. Also, with our apportionment methodology is important. The lack of an income tax is, I think very important and what makes us unique from a lot of these other states. A lot of these other states have equal or higher rates and an income tax. I don't know if I should say this, but just looking at the map, Alabama has the same corporate excise tax rate, but also has an income tax, for example. And then I think there are we do have the lowest per capita rate, regardless of the mix. We do have the lowest per capita sales and use tax rate in the country, as we talked about before. And now, without an individual income tax, with less burden directly on the individuals, we do have we get a larger, let me say it this way, we have the lowest overall taxes, but our corporate income tax is a bigger slice of our pie. We got the smallest pie, but the corporate income tax is a bigger part of our pie than in some other states. We have various incentives such as the industrial machinery credit for manufacturers. Of course, we have a favorable apportionment methodology for manufacturers specifically for that industry. I think it makes it quite competitive. We have the job tax credit for numerous industries. And I think the overall regulatory and business environment, I think, is well documented, and in a lot of ways maybe outweighs some marginal differences in the mix of taxes.
Right. I'm just going to keep asking questions. If members want to be on the list, I'm happy to do that. As it relates to overall taxation, when we looked at doing the single factor back in 2017, I guess it was, the revision during the Improve Act, one of the things that still surprised me, based upon your presentation today, is that 15% of these ratepayers of F&E tax represent, I think it was 95%. 95%, or you said it a different way. It was 15% only represented 4.5%. Extrapolated the other way means there's just 15% that's paying 95%. I think, if I'm correct. I guess.
Yeah, I might not have said that very well. So 4.5% is paid by 85% of the taxpayers.
Okay.
So if you want to say it, the 85% paying the least, paying under 5,000, I think, accounts for only 4.5% of the total collections. So that's the 85 at the paying the least, 85% paying the least. At the top end of the actual payers. You can slice it in different ways. I have a table I'd be happy to share with you, but the top 2% of payers pay, and that's around a couple of thousand taxpayers probably, pays almost 75% of the total tax. The top 0.18%, a few hundred, pay 40% of the total tax. So we're really talking about, just a very small percentage and a relatively small number of the total that pay a really large percentage of the tax.
Thank you. With that, I guess the challenge is with the volatility chart that should scare anyone, based upon what you showed earlier, and with so few number of ratepayers paying 85% of the tax, how would one, if they wanted to cut taxes, how could they do it now that single factor sales valuation is different? I think most of the body sees that if we're over collecting revenue, we'd like to cut taxes somewhere. The question is how would you do it, taking into consideration that volatility? Because if you mess up, the change will be dramatic, more so, I think, than we saw in 2014.
Yeah, I mean, there are things we can do to look at how the changes, let's say, if you want to change a rate or change the apportionment methodology, we can sort of, as a hypothetical, apply that to a prior year and come up with a pretty good number, pretty reliable number in terms of if this different rate or this different apportionment methodology had been in place in, say, 2019. Here's what the impact would have been.
Mhm.
What you don't know is 2023 going to be the same as 2019? I mean, that's right. I mean, those years could look quite different. And then if you've made a change on top of that, I think it's what you're getting at, Mr. Chairman.
Mhm.
If you make a change on top of that, then it sort of maybe could compound that change in collections.
Well, obviously, a week ago we weren't talking about an oil crisis and a war across the other side of the world either. So,
Right.
Maybe now is not a good time to consider any change. But I do think it's important for us, as we continue to see over collections and to look at these numbers to see if there's a way that might be better going forward as it relates to taxation policies of this nature. I guess when you look at 75% of those people, if you were to change it, if they represent, I don't want to mess up, but if 2% of those taxpayers represent 74% of the F&E tax, my question is, what percentage of those 2% use the new factor or the single factor sales or the apportionment tax under the three criteria? Would you say they're pretty evenly spread out, or were most of that 2% is in one category or the other?
That's a great question, and one I'm hesitant to guess on.
Mhm.
I mean, I think
My expectation is that 2%, based upon based on collections, that 2% is probably a 95% chance they're all doing it the same way, right? And that if you were going to effectuate some change in revenue based upon that 2%, that it would be good to know how they're calculating F&E tax and their advanced payments or their projected payments.
that's certainly something we can tell you.
Okay. Well, if you could share that with me, it'd be great. I do have a couple of questions. Representative Shaw.
Thank you, Mr. Chairman, and I apologize to you and to our company for being just a minute late when I came in, so you may have already talked about this. For my sake, because I don't know if I really understand, how is F&E, how do they base paying F&E tax on annual sales or what? Can you talk about that for just a second?
Yes, sir. So it's actually two taxes: franchise tax and excise tax. Excise tax is just another name for a corporate income tax, just like the federal corporate income tax. And so that would be on your net income. What you first do is you file your federal corporate income tax return, and we're only talking about corporations, LLCs, and limited partnerships. We're not talking about sole proprietorships or general partnerships. We're talking about entities that are separate from their ownership, right? So for those types of entities, they're going to be filing a corporate income tax return on their net income. You bring that down to Tennessee, you make some adjustments that are specific to our state, and you come up with your Tennessee net corporate income, essentially.
Okay.
And then the excise tax is 6.5% of that. How it's apportioned if you do business in multiple states is another topic that impacts that, as we were been kind of talking about. But I think that gives you an idea. It's basically a tax on your net income that you earn in the state as a corporation or an LLC. That's excise tax. Franchise tax is on a same companies, the same corporations or LLCs or LPs, but it's on their net worth or the amount of property they have in the state. And that'll give you a figure, how much is the net worth of my company. And the rate is 0.25% or 25 cents per $100 of value.
Couple of questions, Mr. Chairman.
Representative Shaw.
So do you do projections like Blue Oval is coming? Is there a projection as to what kind of F&E taxes they will pay, or can you do that in advance?
That would be really, I mean, that would be difficult to do. And there's so much that goes into it. You know, a major corporation is a complex, you know, and depends on how they're structured and so many factors. You know, we would, without speaking about any particular company, you know, we could look at what information we have based on their current structure and what they do in the state, but that might not tell us a lot about what they do in the state in the future, right? So it would be a tough thing to do. When we produce revenue projections for such as the funding board, we don't really do it on a individual business basis. We do it on a very aggregate basis.
And my last question, who are you talked about that 2% paying that large amount of F&E taxes? Are you at liberty to tell us who those companies are? That's something you can't do.
I cannot. Taxpayer information is confidential. Those folks, you know, have a right to have their tax returns be confidential.
Chair Lady Hazelwood.
Thank you, Mr. Chairman, and good afternoon, gentlemen. Thank you for being here. If you could go back to the map with the F&E tax charts, you know, just glancing at it, Tennessee, as you said, we're sort of median, particularly in Southeast. There are a number of places in the Northeast and some other places that are higher, but there's one like glaring exception, North Carolina, 2.5%. Can you speak to their income tax, their tax mix in North Carolina, and just, I know they have an income tax, I think I know that, but what other things give them the capability of having such a low, having spent a little bit of time in ECD, I know North Carolina is always a tough competitor when you're looking at large projects, and that obviously is one of the reasons. So help me understand how they can do that.
Yeah, thank you, Chair Lady Hazelwood. It's probably something I need to study more closely. I cannot tell you offhand their exact mix. I can confirm they do have an income tax. They dramatically reduced that rate over the last few years. They stepped it down, but it was comparable to the rest of the Southeast. I don't know the exact figure, but it was roughly comparable to the rest of the Southeast until they went through a major reform. I'd be happy for our folks to do a little more research into that and get information to you, share it however you would like with the committee. But I cannot tell you off the top of my head what their mix is.
I think it'd be an interesting case study, particularly since you said they've stepped that down, you know, fairly recently, to see how that impacted their business growth and other things, and if they're, you know, I'm assuming the goal would be to not only keep yourself whole tax-wise, but to grow your tax base. And if they were successful in doing that with a lower tax rate, that would be interesting. And then just another sort of general question. When you talked about the basis for the taxes, the property, the sales, and I've already forgotten the third piece, payroll. Is that how we account for, I'm just trying to understand the difference in taxation for a company that's actually headquartered in Tennessee, but doing business, you know, nationally or internationally, versus a company that's headquartered in another state and just only doing business, or may have some presence in Tennessee, but not headquartered. So how does that impact the taxing for those companies that do choose to be headquartered here?
Yeah. First thing, to be clear on, not every company apportions. There are plenty of companies that operate just within Tennessee. They don't really extend their business outside the state, and they don't file in other states, and so they don't apportion at all. It's not a issue for them. But for multi-state companies, really, I mean, it really comes down to proportions. It's not so much where you're headquartered. I mean, if you are headquartered here, you may have more employees here, for example. On the other hand, you may be a national company doing business in 50 states, and your headquarters staff that you put here may be a really, really small number compared to your total employees, right? So it may not be much of a factor at all to move, a headquarters staff here. I don't mean to talk in extremes, but it may have a relatively smaller impact bringing your headquarters here if your headquarters in terms of headcount is relatively small compared to all your employees everywhere. So it's really a factor of how much of your payrolls in Tennessee versus everywhere, and your property and your sales, and it's really highly individualized depending on what type of business you are, where you make your sales. Do you distribute your sales nationally, or do you distribute your sales, to maybe a another entity that's located in the state or in another state? What type of distribution do you use for your sales? Because your sales factor depends on the location of your customer, right? So if your customer's out of state, you're going to have a significantly smaller sales factor than if your customer's in state. And it's just a lot of different factors that go into it. I don't think putting your headquarters here is going to drive that so much as just your overall, business structure and what you have in a lot of different states for your business as a whole, as opposed to just your headquarters.
Thank you. I know it's just one of the things, you always think about, just like any business, it's easier to retain a customer that you have than to gain one that you've lost. And the more sticky factors you have tying a customer to you, the better off you are. And it just seems if you have a company headquartered in Tennessee, then it's more difficult for them to, take their business away from the state than if they don't. So I was just curious if there was any tax benefits or harm to being headquartered here. Thank you.
Thank you, Chair Lady. Just as a follow-up, so an idea of, just to make sure I understand, apportionment would mean I build or own a facility that distributes products, goods, and services inside Tennessee, but I might send them to Kentucky, North Carolina, Georgia, or surrounding states, but they're able to apportion a portion of that tax into the other states. Is that what you mean?
Yeah, it's really a matter, I guess, as an analogy, sales tax. You think your ultimately your tax liability as a business depends on how much is taxable, the base, and what's the rate applied to that base, right? For sales tax, something like sales tax, pretty straightforward. The base is what you pay for whatever you bought. There's not a lot of variation in that. It's the price you paid for the goods you purchased. It's all about the rate, right? For F&E, it's a little more nuanced because there's a lot of variation in how you arrive at how much is subject to tax. And that's really aside from the rate itself. And, that's partly a function of just what is your net taxable income, your revenues minus your expenses. But it's also for those multi-state companies that do business in more than one state, we have to have a system for the states to basically divide up the pie, divide up the income, and how much is taxable in Tennessee versus, Alabama and Georgia, et cetera. And that's apportionment. we're talking about apportioning among the states that company's total net income. And there's a traditional formula of three factors: property, payroll, and sales. Traditionally, it was equally weighted, you know, and that's how you determine how much how much of that company's total business is considered Tennessee business. But over, the last, several years, couple decades, there's been more and more sort of variation in that original standard three-factor formula in how the factors are weighted. There's been a trend toward putting more weight on sales because, in essence, when you place a weight on property and payroll, you're calculating how much is subject to tax based on property and payroll. So if someone puts more property in the state, capital investment, or more payroll in the state, jobs, then their liability generally is going to go up if that's part of the formula, right? But sales sort of occur wherever they occur in large. Nobody's going to put less sales in the state, right? Nobody's going to choose to sell less in the state. So that's why the states have an incentive to place more weight on sales and less weight on property and payroll. And that's the trend. And then the farthest extension of that is to place 100% of the weight on sales and disregard property and payroll altogether. And that's what we've done for manufacturers.
Thank you, Commissioner. I don't have any more questions on my list, but as the chair lady asked previously about the study about North Carolina, if you could share that information with her office, when you get a chance, I would appreciate it. Also, the information we discussed about the 2% paying the 74%, if we could figure out what the strata looks like or the different types there, whether there's some similarities there. I think the key going forward, if we know 74% of the tax is paid by 2% of the folks, and they're all paying it the same way, to me, if we were going to cut taxes for a group, that'd be a good place to look to get the others and do some kind of change that the others could conform to.
Mm-hmm.
Seems like it would make the most sense to do that. I think simplification as it relates to the tax code is always important. If we can find ways to do that, that would be good. But we appreciate your time today and for the members being here. Do the members have any other questions? Seeing none, we're going to go back into session. Thank you guys very much for coming. As a reminder to the members, next week we'll be continuing budget hearings through this time. So those on Appropriations Subcommittee will not have a reason not to be here next week. But anyways, it's good. We appreciate that. And then the following week, we will have a discussion on the 7th about new market tax credit and community enhancement taxes. And then the following week on March 14th, if you notice, there was no megasite presentation here today. At the discussion with the speaker and the stakeholders, we've determined to make that a day all in of its own. So we'll have multiple speakers, and they'll be coming on March the 14th. Do the members have any questions or any comments? If not, we'll move to adjourn.